the Energy Markets podcast. It's great to have you all back. Happy New Year. We haven't seen some of these faces since we restarted our podcast this week. And it has been quite an eventful couple of weeks to start the new year. So let's get cracking and hear from Jamie Ingram, Senior Editor at Mees, Paul Horsnell, Head of Commodities Research at Standard Chartered Bank, and Mukesh Sadev, SVP, Head of Downstream and Oil Trading at Rystad Energy. Thanks so much for joining us, gentlemen there. I'd like to put up that survey result that we got from a question earlier this week, which is, of course, about the shipping lanes around the Red Sea to get better or worse with US-UK attacks on the Houthis. We have seen, some more activity since Monday as well, and that seems to be escalating for the time being. 89% agree with that's going to continue. Mukesh, let me go to you first then on that and get your take on how big of an escalation is the market reading this at, and how is it going to impact prices, shipping, etc., and thinking around oil trade?
No, thank you. Well, good to be back, and this is indeed on top of everybody's mind. I think I would dissect the question into two, whether there will be disruption. I think everybody agrees that yes. Whether this will impact the oil market prices in a big way, probably not, because I think we have gone through a lot of crises now, and what the world has learned is that most often we have been able to navigate around and find alternate ways. So it's hard for me to speculate on the geopolitical turnout, but I think based on the numbers we see, based on the flows that goes through the Red Sea, right, certainly there are alternate route options and the alternate ways to supply. And we are also in a point in the market where we are not in a stage where the oil demand on every aspect is back, right? We are in a world where still there are bearish sentiment on the oil demand side. And so I will say that the disruption for sure, system will find alternate ways and means. There is a lot of leakage in the system also that happens. And this will probably not be such a huge price mover as we have seen. So that's what I would say at the start.
Okay, thanks, Mukesh. And I guess we just have to look at what's happening to prices to see how much they're moving. They have moved as a result of disruption, but not to the extent where we would interpret it as a disruption to oil flows. Jamie, let me go to you on that point of, well, it's also in a period where demand has been revised downwards for the year from last year. We have enough supply still. The market's telling us that. And the demand outlook isn't looking too strong, so perhaps not so much panic about any major disruptions. What's your outlook for that for the year ahead? And what will it take for activities like this in the Red Sea to actually disrupt the market?
Hi, Diana, and Happy New Year to you. Yeah, as you said earlier, the Red Sea is all that anybody can be talking about really at the moment. Yeah, generally I agree with Mukesh on his comments earlier. In terms of, is there going to be disruption? Absolutely, yes. Is it going to be significant? Well, we're seeing the market kind of trading quite range bound at the moment. In the mid 70s to maybe creeping up above 80 on a good day, but no more than that. I mean, there is clearly significant potential to reroute a lot of these trade flows around Africa rather than going through the Red Sea. And I think that it's also very important to note that clearly Saudi Arabia, the Middle East's largest oil producer, has significant oil export capacity on its own Red Sea coast. So generally when it supplies Europe, most of the volumes go up from Yanbu through Egypt, Sumed pipeline, and then on into Europe that way. So it doesn't most of those volumes don't actually go through the Bab el-Mandeb, go through the southern Red Sea, where we're seeing this Houthi attacks on shipping. So that's for crude oil, and likewise for refined products. Saudi Arabia also has a lot of refineries on its Red Sea at Rabi, at Yanbu, which it can then send northwards up into Europe, across into the Americas if needs be. Also, clearly, the primary source of supply growth in 2024 is seen as coming from the US. So what we're going to see here is perhaps even more of that new US volumes being pulled into the European market to replace volumes that while they can still come over from Asia, perhaps the price rationale for that making that journey is no longer as strong as it is, given the impact on shipping prices, on insurance prices, etc., for bringing those volumes over from Asia. So we might see even more of a surge in that cross-Atlantic US-Europe trade flow over 2024.
Okay, great. Thanks, Jamie. And I did want to get to the US production and talk about that in a bit more detail, but we'll go back to that. Paul, good morning again. I mean, on the cost point of view, we haven't seen a disruption to flows, but a slowdown, rerouting, etc. That clearly comes at a cost, right, to shippers and to those who own the ships, those who are even shipping the oil. Given that we're in this environment still of, relatively higher interest rates here to stay, do you think that's going to impact at all? Is that a worry? Central bank policy, etc. And how will that feed into, if you like, decisions on in terms of operators of those who are moving oil around?
Yeah, I mean, I think more generally, most estimates, and certainly the ones made by my colleagues, suggest that the overall increase in shipping costs is enough to add, maybe 0.25% onto inflation, certainly through the OECD. So it's an impact, but it's not so big an impact that it carries everything else before it. But certainly for central bankers, that is a concern. Anything that at the current time makes inflation stickier is something that they more or less take on board. I think from an oil point of view, I think there's 2 points. On the cost of the diversions itself, obviously great news if you are selling bunker fuel out of Cape Town. I mean, this is a lot more bunker fuel is going to be used in terms of that extra 10 days, 12 days of journey time. It does mean that oil at sea is going to be increased because the supply lines themselves have grown longer. So there's more oil there needing risk management, more for the supply people to keep in their chain at any one time. So there are, the effects are not totally neutral. It will affect the crude oil differentials, that this is a boost for short haul crudes like Brent against longer haul crudes like Dubai. So there are some effects. But I think the bigger thing is the overall market reaction to rising geopolitical risk. And I think it's a bit like one of those kind of rather gruesome biology experiments that they tell us about at school when they want to sort of slightly freak the children out. The one about the amphibians being placed in water and subjected to gradually rising temperature. The point being that the temperature doesn't matter to the, okay, let's call it a frog, to the frog until the point where it does matter, when it does become too hot. And I think the market's behaving a bit like that. So the explosion of violence in Gaza, oh no, it doesn't matter, there's no supply interruption. Spreading of that into Vladimir, oh, it doesn't matter, it's just an extra bit of risk. The Red Sea interruptions, doesn't matter. Iranian missile attacks on Pakistan and on Iraq within 24 hours, oh, doesn't matter, it hasn't affected. So you see this sort of just continual absorption, this saying, oh no, the world's different now, we don't. And I do wonder if we're getting to this kind of point where it doesn't matter, again, rather like the frog, until the point where it does matter. And that implies to me that, should we say that some of the optionality in current oil prices is a little bit wrong. It's very low volatility. We're going through the same price every single day. Exactly 77, 97 on Brent. We've been there every day at some point this year, and 13 trading days in a row. So it just feels that something doesn't quite add up yet. And I just feel that we're, again, in this state where it doesn't matter, but at some point it might.
Okay, thanks, Paul. So Mukesh, back to you on that. I mean, is the market being complacent? And is it because, it's short, essentially, it's got a short view, if you like, on the outlook for the 2024. We have an interview actually coming up. We're going to play that today with Dr. Amrita Sen that we did at our Global Energy Outlook Forum last week. And she said the geopolitical risk premium that Paul Horsnell just mentioned, it will only be felt and factored in once the market's ready to go long, i.e., we think oil prices are going up. So where is the point of view of the market as we start the year from a price range point of view, would you say, considering increased US production, expectations for OPEC policy, where would you put the expectation?
No, I think that's a quite a number of factors question. So let me kind of break it down. But first, I also want to agree with Jamie that US barrels is a big part, and there are players who would be ready to pay a security premium. I lived in Houston for many years from a trading perspective, and I understand that there is a security premium certainly US barrels attract. So the only thing for the US barrels is that in 23, they grow about 1 million barrels. So far, the forecast for 24 is about 500,000 barrels growth, right? But we know that US shale can surprise. So I think even if a lot of analysis fundamentals tells us that US production may not grow, I think the sentiment and the actors believe that US can always play a surprise. So that plays into the market sentiment, number one. Number two, I guess on the demand side, it's clear that last year, 23, because of 22 base numbers, was at 2.8 million barrels per day of demand growth. 24, that number has come down almost half, 1.1, 1.5 million barrels per day. And a big part of that growth is obviously Asia. And a big part of that growth we have is about 700 KBD of jet growth. Now, jet, everybody has been hoping that jet will come out of the jet lag. And I think that's not happening so easily because of the bottlenecks in the aviation system, possibly. So jet demand, also people are risking that it may not come back given the geopolitics, people may not travel. And China contributed a big part in the aviation by global travel, which is not happening at the moment. So once we put together that supply side, even if the numbers tell not good, but the sentiment feels it will be there. On the demand side, a bit of the bearish side, I would put that our expectation is that still the market may not be factoring some of the quality challenges with the refinery sector, right? Refinery outages, weather events, will happen. Refineries with the OPEC cuts are not getting the right kind of crudes, which they used to get for optimization. So I believe the product markets will stay challenged. China has also released a full year crude quota. And I believe that some people thought that this will stabilize the market. My view is opposite. Now, China can keep the world guessing. Instead of doing a batch-wise release, now China will keep the world guessing. And that brings my point around OPEC. OPEC will certainly factor into account that now China is no longer giving a quarterly indication of what they will buy. China certainly is increasing capacity this year, and they have given an indication that even the teapot refineries, which were eroding, they don't want them to erode as much as, because everybody believes that there is good life left in the refined products market management. So if I put all this together, I believe that the OPEC policies active management will continue. If there is any slump or demand bearishness on the refined products market, I think there is an emerging signals of something like OPEC style management in refined products market, where now Russia can cut the diesel barrels. Now Russia sees opportunity because of the Red Sea. So the diesel exports from Russia rebound. So active management of crude market is happening, will continue. Active management of refined products market will become a dominant factor in my view of 2024. And with that, I believe the prices will stand close to mid or high 80s once we approach the summer. And I think that's where Paul probably was indicating that it doesn't matter, it doesn't matter. I think the time to matter would be the summer of 2024. And if that really turns out well, then all what we are talking, which seemingly doesn't matter, will matter. So we have a higher price call compared to what we are seeing in the market.
Okay, thanks, Mukesh, for that. Very, very thorough. Jamie, let's talk a bit about OPEC Plus in that context and their ability to rely on Chinese demand this year. And their likely policies, if you like, going forward. A lot of people are saying the cuts they put in place, the extra ones that came into place due to the first quarter, that's not enough. People are already saying at least till mid-year. What do you think is happening with OPEC's thinking now, given what Chinese demand expectations are, Asian demand in general, and the sort of variant refinery bucket, if you like, that's happening in Asian markets?
Sure, Diala. Yeah, so with OPEC, as you say, that OPEC Plus, those cuts are due that they're for Q1 this year, but it's worth noting that even under the assumption that they might end at Q1, it's going to be a gradual taper. So there won't be a cliff edge in April. They're going to phase out these cuts throughout Q2 as well. But as you say, market expectation is very much that they will be extended in full beyond Q1, probably into Q2. I think when it comes to what their key calculations, what their key priorities are from the conversations that I've had, is that they're looking to try and create a really significant inventory drawdown in Q1. So that's the key metric that they're going to be looking at. They're looking ahead and saying, okay, we might still see stock builds later on in 2024, but if we can draw enough out of inventories in Q1, then over the course of the year as a whole, it will all balance out. So if those inventory drawdowns are not as significant as they are calculating on, then that's going to be the key metric that will lead to a potential extension of the cuts in full into Q2. China has clearly been the key source of demand growth for them in recent years. It was fairly strong last year as well, but I think they're increasingly looking to India as well. That's kind of starting to take on a lot of the mantle of global oil demand growth, Asian oil demand growth, as far as OPEC Plus is concerned. Longer term as well, I mean, we're seeing Saudi Arabia, people talk about the, how much of a concern is it for Saudi Arabia losing market share to Russia in China? We're starting to see Aramco kind of grapple with that issue somewhat when they're starting to have success in picking up refining shares, shares in refineries in China. So that's really going to be bolstering their market share within China for the longer term. So I don't see that perhaps these market share concerns being a key priority for Saudi Arabia over the long term.
Okay, well, that's interesting. They are being raised, obviously, just because of the US production figures. And of course, there's other output as well coming from the Americas. Paul, let's just talk about the sense, I mean, from a general commodities point of view, other commodities, not just oil, what they're telling us about the sentiment for the global economy going forward this year. Are people long, short on various economies, taking into account, of course, Europe as well, and manufacturing in the US. The US economy has not had a hard landing yet. Inflation's coming under control. It's all looking still pretty healthy. Do you expect we're going to see the trickle effect of interest rate rises finally hit this year, or what? Where's the sentiment there?
Yeah, I think first I'd like to really strongly push back on this idea that demand is weak. Oil demand growth, we think this year 1.54 million barrels a day. That's above the medium-term average. I haven't seen a forecast out there by people actually do the numbers of a weak demand growth this year. It's in the mind. It's and I think there's a danger of us getting sucked into this. Oh, demand is weak. The outlook is poor. The U.S. economy, recessions. Because I think we think back exactly 1 year. This is exactly the same discussion that was being had 1 year ago. That the demand outlook is weak, everything is dreadful, the recession is coming. And of course, what happened is demand surprised very heavily to the upside last year. The only agency that got it right really was the OPEC Secretariat. Their view was ridiculed at the start of the year. By the end of the year, everybody revised up to. And I think there's a danger that we're just going to make exactly the same mistake of this sort of morass of we're just looking for the cliff edge and demand to fall off. See no evidence in the numbers, just see demand surprising to the upside. And same sort of category, again, US supply, non-OPEC supply growth. People are talking as if it's going to accelerate this year. It's not. It's going to slow down really very fast. There will be growth, but there's not going to be anywhere near as much non-OPEC growth as last year. So I think I do just push back on this general concern that OPEC is in a dreadful a problem, that demand is weak, etc., etc., etc. I think it's a very manageable market, and market management will continue to push prices to a level which is more acceptable to both, or at least it works in the balance for both producers and consumers. But I think overall positioning, you're exactly right. Most investors are trading a macro view, which is still very downbeat, and that is one which at the moment involves being fairly negative on the bulk commodities, being particularly negative on crude oil, but surprisingly being in relative terms much more positive about oil products. So and again, I think that's much in line with many of the things that Mukesh was saying there, that there is just that nuance that very easy to short crude and copper on a negative worldview. But I think those who are perhaps a little bit more bottom up are choosing to take their long exposures perhaps more on the product side.
Okay, thanks, Paul. There's our survey question for today. What will be top of mind for OPEC Plus at the start of this year as it decides on output levels, on cuts, no cuts, rolling those back, extra, etc.? Will it be China demand prospects, rising non-OPEC production, and or central bank monetary policy? So what would be top of mind of that, or the greatest concern, I suppose, factoring into its decision making? Mukesh, just back to you on that product. I mean, you mentioned a few things there. Jet demand. I mean, we had quite a few people on the Global Outlook Forum last week saying that the jet demand forecast for China for the summer, or for the Chinese New Year, etc., actually is forecast to be stronger than pre-COVID levels, domestic sort of travel, I suppose. So the geopolitics probably doesn't even play a part in that in terms of hesitancy to travel. So that looks pretty positive. And then secondly, on Russian, you mentioned diesel. Last year we had that point in time where Russia was sort of threatening diesel supplies, and it did impact the market. Do you think that, this year we're going to have the same vulnerabilities to Russian flows, or are things pretty settled into a pattern which suits both parties essentially?
No, I think I'll build up on what Paul was mentioning, that there is a bit of a demand, how we look at the numbers, right? The COVID and the crisis has damaged our normal base numbers year on year. So sometimes the year on year numbers look very, very high because the previous years was very bad. But I agree with Paul in some way that 1.5 is not a bad demand when we look on a medium. But I think the key point to note is that now with the talks of the energy transition and those things, there are some sectors which are doing good. There are some sectors which are in trouble. Clearly, jet demand, I would say, is in lag. And we, in our numbers of 1.5 million barrels per day, 0.7 million barrels per day is a jet demand growth. So we do have an expectation that jet demand will grow. But given the not the consumer appetite to travel, I guess it is the supply chain bottlenecks in the aviation sector to support the demand that is a bit harder to judge and forecast. So that's what I would say, that maybe 1.5 may not turn out as it is, and jet may not perform. The other sector, where China matters a lot, is the petrochemical sector, right? So I speak to a lot of people in the refining world, in the petrochemical world, and clearly projects are getting canceled. China has built a lot of capacity. Middle East has canceled a number of projects, I believe. A big Singapore Shell refinery is also now, in a different state of discussion. So I guess petrochemical demand also is not as high, as good as expected. So there are demand weaknesses there. Gasoline, we believe, was 600 kbd last year. This year, it will be likely only 300 kbd growth. So what probably is growing in a sector way might be different. Fuel oil, like shipping demand, because of all the inefficient routing of the trade flows in the world, would likely provide some support to the demand. So if we keep, I think, demand side, yes, overall numbers may look okay, but when we compare on a growth basis, petrochemical is not performing. Jet, we believe, will perform, but there are risks associated with it. So if from that perspective, I believe that OPEC and China, the way they are managing the quotas now, Russia manages by quotas. They choose when to release more diesel, when to release less diesel. China will do the same, when to release more diesel and gasoline into the market. So that's where I see that whatever the demand will be, there will be active management of not just the crude market, but the refined products market, right? And there is no OPEC plus kind of situation in the refined products market, and it's not easy to emulate or copy paste that crude management in the products market. But I believe that this will continue to happen. And now Russia sees opportunity. They will bring barrels into the Turkey, and then it will go everywhere else. And Russian system has found ways around the insurance and the shipping. So the oil will continue to flow, whether it's a sanctioned oil or a non-sanctioned oil, and active management of product market will continue this year. And that only means prices will not go down despite whatever sentiment is around the table.
Okay, thanks very much, Mukesh. There were some extra sort of stringent sanctions discussed at the end of last year, but they don't seem to be filtering through yet. Let's talk a bit about, Jamie, just before we wrap up in a few minutes, gas. I mean, that is not managed by OPEC Plus and does not have a similar type of organization. We've seen the gas markets very, very mild, I suppose, along with the weather over the winter. Nothing like a year ago when we had crisis in prices and supply and cost of living crisis, etc. And inflation, of course, was a whole other game. So, Jamie, the outlook in Europe and Asia in terms of gas prices going forward for the year ahead, do consumers, whether industrial or home consumers, feel more relaxed about that as we go into the new year?
Definitely feeling more relaxed. Yeah, from prices, definitely the consumers are feeling much more relaxed. Storage levels are still at high levels. Prices have moderated considerably. And in terms of supply, that seems to be quite secure at the moment. Obviously, again, everybody points to the US as that's where there's been a massive surge in LNG supplies over the last year. Some projects have been delayed. There was hopes that in the US, Golden Pass would be starting to produce by the end of this year. That looks like it's been pushed into 2025 now. So that's probably not going to come in time for next winter. But yeah, back to this one. We have been blessed, I suppose, with another mild winter in general. So that's managed to keep the wolf at bay for Europe and for Asia from a gas price perspective. And people are looking at the kind of Red Sea disruption. Qatar LNG, it's diverted a few cargoes that were meant to be heading that way. But again, for now, at least, it seems that just rerouting should be more than sufficient to ensure that LNG volumes remain stable.
Okay, I mean, Paul, on the LNG front, in terms of capacity, we're expecting global capacity additions to come online, perhaps not this year, but more next year and the one after in terms of the big additions there. But I'd like to get your perspective on gas and how that fits within the commodities bucket. There's our survey result. No one has voted for China demand prospects, which is a little bit concerning. But there you go, 64% rising on OPEC production, which many said was what really kind of threw a spanner in the works of OPEC's plans last year, although they still managed to keep prices supported more or less with the cuts. Paul, to go to you there then to close up for us on the outlook for gas markets.
Yeah, well, I very much agree with Jamie, and I think suddenly there has been a sudden cold spell through Europe. So the inventory draw over the past week, has been the largest 7-day draw for 3 years effectively. But it's coming off a very high base, and as we said, now getting to the point where you can see the end of the winter. So the market is still relatively relaxed and staying most of the time close to this kind of 30 euros per megawatt hour level. US, I think, is rather different. And the cold snap at the moment does appear to be causing another Permian freeze-off. We've had those 3 years running. No idea yet of quite how big the freeze-off is going to be this time round. But combined, say, lower oil and production out of North Dakota and the Permian, lower gas production out of the Permian potentially. And that's why you've seen this very sharp rally in Henry Hub prices over the course of this year so far. By far the strongest commodity of all in terms of year-to-date performance. And so still acting very, very independently. But I think for the moment, the market is hyper bullish on US gas, at least short term, but still very bearish about both short term and medium term prospects on TTF and other European indicators.
Okay, Paul, and just want to get just from the three of you, just your outlook for, I know you've mentioned it a few times, the US oil production. We had a lot of people talking about it last week at the forum. And we did have one or two voices saying, no, we actually think this is going to plateau here now and actually begin to decline because of the way the drilling works and shale. Others more were saying, no, this time next year we could see another blip, not the same blip we saw in 2023. But very quickly, Mukesh, will we see US production plateau where it is today or drop or go up without getting into too much detail?
US production will grow. That's the number. It will grow probably more than 500,000 barrels per day, for sure. I think that would be my view. And the reason is, despite the rig count and all those, we find the productivity increase, and there are so much going on the US shale. So it will grow. It may not grow to the same extent as it did last year.
Okay, Jamie?
Yeah, I agree with Mukesh in terms of pretty strong growth from the US. I think basically it never serves to underestimate the impact of efficiency gains, technology growth, etc. in the US shale sector at the moment. I think that's going to continue unlocking new reserves for quite some time.
Okay, and Paul, we'll give you that last word. Just yes or no, up or plateau?
Oh, I could do better than the yes. In brief, about 1 million barrels a day less growth than last year in total or liquid. So a huge deceleration. Drilling is down 20% year on year. There is no productivity gain that gives you 20% in a year in the oil patch. So a sharp deceleration. The market is not pricing that in yet. It will do, and that's back onto Mukesh's point that mid-year is perhaps when all of these things become clearer to the market.
Okay, well, thanks very much, gentlemen, for joining us today. We've run out of time, but thanks so much for joining us and have a good one.
Thank you.
Thank you.
Bye-bye.